Hello, everybody. I'm going to be sharing a couple new indicators that I've developed over the past few months. I've made a video recording of this indicator in the past. This is my second video recording, and I'd like to um, show you how this indicator, what this indicator does, how it works, and how you can use it in any market environment or any asset. My background is smart money concepts and mostly trading price action. So these indicators are structure based, meaning I've developed a way to quantify and qualify structure in markets based on just open, high, low closes. And so let's start with, let's go to, let's pick the dollar, for example. I'm going to um, turn this one off for a second. So basically what I'm trying to do here is identify market structure and determine when that market structure could be potentially turning or shifting. So as we all know, for making higher highs and higher lows, we are in a bullish structure. Lower highs, lower lows, bearish structure. What this indicator does is it tries to kind of quantify that, and it's using three different lines. So there's this bottom line here, which is representative of the low end of the dealing range. Okay, so if we're here in this particular um, time frame, the 4 hour on a dollar DXY, this is the dealing range. It's between this gray line up here and this red line down here, which ultimately eventually turns gray, and I'll explain why. So the color changes for these two lines that provide the dealing range give you a bias determination. So when the line is red, the bias is generally bearish. When the line turns gray on the bottom, it will turn green on the top, and the bias switches to bullish. Okay, and the transition between a bullish structure and a bearish structure are pinpointed by these red and green arrows. Okay, so that's when you have a significant structure break that changes the bias or the structure. Another line that you see is this dotted line. This is the equilibrium line. So this is basically the 50% of the midpoint of the range. Okay, and this line also has significance. So it can either be red, yellow, or green. So when it's red, it means that the even though the bias turned red here, so we have a bearish structure, okay, and the midline also turned red, so it's confirming the bearish structure. As soon as it turns yellow, okay, we have some opposition here going on, meaning yes, we're in a bearish structure overall in this dealing range, but yellow means that it's potentially turning into either a consolidating market, or it is not as bearish as it was here. So when you have alignment of color between the bottom line and the midline, okay, so when they're both red, it means the momentum to the downside is strong. You have bearish structure. and you also have short-term bearishness. But when this turns yellow, it just means that your structure is still bearish, because for it to turn bullish, it actually has to come and take out this high. Okay, so your structure is still bearish, but the yellow just means it's not ideal, meaning you have a potential turning point where markets are going from bearishness to consolidation, and then potentially reversal. Eventually, it did reverse here. Okay, so we have a reversal point here, and these reversal points are not necessarily buying opportunities. So you don't want to necessarily buy when you see these arrows. I guess, I mean, uh, you could start buying into this, but ideally what you want to do is you want to wait for a pullback into a recent low that is breached. Okay, like here and here. So these levels here give you better prices to get in to the long position to align with the structure. Okay, so when a structure changes from bullish to bearish, it doesn't necessarily mean buy at the change, but start looking for bullish patterns to get into alignment with the overall structure. Okay, so as you can see, the dealing range also changes. So here, for example, as soon as we make a new high, okay, so we have the top of the line now green, so that's telling us the structure is bullish. The bottom of the line is gray, okay, which is telling you don't pay attention to this line. You want to be looking for opportunities to get into trades on the long side. And eventually, what you want to do is you want to actually look for price to breach equilibrium levels. So equilibrium levels are these, as I said, these dotted lines, right? And when they're in alignment, so when they're green, okay, and price comes through the equilibrium level, taking out a previous low, ideally, those would be good opportunities to get into trades in alignment with the bullish structure. Okay, so we trade all the way up to here. As you can see, we start now seeing some indecision. Okay, so yellow just means yes, the structure is still bullish, but you have to be more careful. You have to start paying attention, because we may be entering a consolidating market. As you can see, we have some consolidation here, and then here eventually we break the bullish structure. See, we have this red transition point. Okay, so as soon as we break the bullish structure, green stops being green, turns to gray, and now the bottom line becomes red, and that tells you we have to start looking for selling opportunities. So what do? We wait for price to come up into or above the equilibrium point. Okay, so uh, the best entries are when going short. The best entries are when you are taking shorts above the equilibrium point of the dealing range. Okay, and here in this particular case, the dealing range is from this level here all the way down to here. And this is the 50% line. These are areas where you want to start looking for sells. Okay, now as you can see, we have a mix of red and yellow. Okay, so that's telling you that yes, you could take a sell here, short, but you have to keep in mind that you're in a consolidating range. You're in a consolidating market. Okay, so as you can see, as soon as we start breaking new lows, it's somewhat a confirmation of the structure turning bearish, and again we get another trade into the equilibrium point that gets rejected, and then we start taking lows again. So we are in a confirmed bearish structure here, okay? Sometimes we don't get the pullback into equilibrium, okay? Um, so it doesn't mean you don't it doesn't mean you can't take a trade, but obviously the better prices are going to be above equilibrium, okay? So here, here's an example where we traded all the way down to here. We've maintained a pretty bearish structure, confirmed by the actual structure and also by the short-term uh, trend of the equilibrium level. Okay, so the color change in the equilibrium level, just think of that as a shorter term indicator that tells you whether there is confirmed bullishness or bearishness in price action. Here we started transitioning into a consolidating market, and you can see we've kind of started consolidating a little bit until we resume the downtrend. Okay, so this is the 4-hour Dixie chart. Now, if we go to let's pull another chart. Let's say, suppose we want to look at, let's look at oil. So this is the oil contract. Let's go to a daily. Okay, so this indicator actually works across multiple time frames. Okay, so in this particular case, you can see on the daily chart, the dealing range is very apparent. It's between this high here and this low here. Okay, so this is our dealing range right now. This is our midpoint, and we're still in a bullish structure, maybe sideways because of the prevalence of the yellow here, just telling you that yeah, you're bullish, but you're potentially more in a consolidating environment. Okay, so you can see this gray line here. So the bottom of this dealing range is, so if this lower dealing range would have been or is breached, then the structure would turn bearish, meaning you would start seeing a red line being printed, and then this green line here would turn into a gray line. Okay, so going down to a 4-hour, you can kind of see, what the shorter term structure is on a 4-hour. We've been in a bearish, structure since, let's see here. Let me pull this out here. Since October 2nd of this year, we've been in a bearish structure, and you can see how it held that very well. So we turned bearish here with this market structure break, and then we held it. Opportunities to sell had you respected or taken the advice of only trading when price enters a premium zone. So you want to go short when it's above equilibrium. So this zone is premium with respect to this dealing range. This is discount. So for short positions, you want to be short above. You want to start looking for shorting opportunities above the equilibrium point while it's telling you that you're in a bearish environment based on structure, and then sticking with that position, as long as you can. I tend to scale out when we breach new lows, and then hold a little piece and maybe hold a core position, but keep adding to the position if you get these opportunities where, again, for example, right here, you can see how we've, the dealing range changed from this level down to here. And then, so now you had an opportunity to get in short on this wick just above equilibrium. Okay. Now, sometimes you'll notice these X's with BSRs. So that's a buy side raid. Okay. So when you see these X's, those are actually very nice entry points because what it's telling you is it's taking out liquidity, buy side liquidity in a bearish environment above equilibrium. So those are actually very nice entry points. So as you can see, we keep trading lower. And then here, just today, this is why I wanted to show you this chart because this is an interesting transition here. We've actually switched to a bullish structure for oil on the 4-hour by breaking a key level here. Okay, so we have a key level break, we have a green print, and now you can see how we've transitioned from a red to a gray below, and then a green line above. So what you want to do here now is you want to wait for price to come down, touch the equilibrium point, or trade lower below the equilibrium point, and then try and capture that long to target potentially these levels up here. Okay, so now I'd like to talk about another indicator that I overlay, and this indicator also provides me a level of bias, but it also gives me a level of um, insight on where I should be targeting, like which levels I should target when I'm in a trade. So this is the Bias Navigator AI. So we uncheck that. I just unchecked it so we can see what I'm plotting here, and it's very simple. So these are boxes. These green boxes represent buy side liquidity pools. Okay, so this is where orders are stacked, and I'm a true believer that markets tend to draw, or I guess price likes to draw towards these levels because these levels are like magnets. Think of them as you could think of it as a very good analogy that I use, having some sort of an engineering background, is you're in a solar system and price is kind of your price action or the current level is you could think of it as a little spaceship, right, that moves around, and as it gets closer to these levels, you could picture these as planets. Okay, so as it gets closer to them, what happens, there's a some sort of a gravitational pull, and so that when these levels get hit, they disappear. So if this level here gets hit, it will disappear because it's already been rated. But then the next level is this one here, and this is a much bigger level, and you can tell by the number as well. So the higher the number, the more important, the more significant that level is. So this level here has a lot more draw than, for example, this level here that's only printing a 1. Okay, so you could think of it as you're in a spaceship, and there's gravitational pull, and these are little planets in your solar system. Um, I don't know if this makes sense to everybody, but I like this interpretation because it does make sense to me. Like these are magnets, okay, and the closer you get to them, the more pull, the more attraction. So looking at this chart on oil, I know that there's a very big level down here. Look at this number here, 1537. Okay. In fact, if we go back to a daily time frame, you can kind of see, um, where this level is. It's like right down here. So this is a pretty significant level. Okay. Um, so we have to keep in mind that that could still be on a higher time frame. That could still be a draw. But on a lower time frame, we have to follow structure. So we've entered, or we've transitioned from a bearish structure to a bullish structure. Okay, so now we want to be um, looking for long opportunities. Now, so what I would do is the ideal trade would be to wait for the equilibrium to be hit or traded below, and then getting long below equilibrium. Another approach, which is a little bit more aggressive but also valid, is, so you can see these candles. There's red and blue candles. Okay, so blue candles represent imbalances, bullish imbalances, and then red candles represent bearish imbalances. And you can read up on imbalance; it's all over the internet. But it's basically an indication of momentum. Okay, so what I like to do is I like to look for price coming back into these imbalances. Okay, because these imbalances more often than not provide some level of support. So imbalances are just a a measure. Well, it's two things in my opinion. Okay, it's a measure of momentum or energy. Okay, immediate. I like using that versus any other type of indicator, because any other type of indicator is going to give you lag, where this is telling you the momentum for that particular candle instant. So I like that idea. I like that concept. But it also tells you that there's an inefficiency. So price did not trade efficiently or did not offer uh, enough price action in that zone, so that what usually happens is price will come back and trade back into that zone before moving higher. So um, seeing when, as soon as you see a blue candle, that's an indication that, hey, if I want to see it trade back into the blue candle and potentially get long in that zone and then go higher. Same with red candles, right? So if this is a good example. You have this big imbalance, okay? You wait for it to come back into the imbalance and then short and go short, okay? This is another example here. So you had this little imbalance here, came back into it, and then rejected, okay? This particular case, the bearish imbalance failed because came down and then it completely filled it and it broke structure, okay? So it's not always going to be, obviously, like, nothing is 100%, but it's just another level that you may want to keep in mind. And it's why I like highlighting them, because it gives me an indication of momentum. Okay, so imbalances are a very good area to accumulate orders. Anything below equilibrium is a good level for longs, um, and then these BSRs. So in the case of in the bullish case, if you, instead of seeing a BSR, you'd see an SSR. So an SSR would be a sell side raid. So a sell side raid is when a key low is raided. Okay, so offsetting. Think about it. You're displacing everybody that is currently long. If there's a low that's apparent, it's going to get it more than likely is going to get rated. Okay, so the liquidity is going to get absorbed, and traders are going to get stopped out, and you want to get in. You want to be on the other side of the order by buying their stops and getting into these, you know, uh, good areas, and aligning yourself with the structure. Okay, this is why I created this indicator, because it gives me a very objective way to look at markets. Okay, I want to trade structure, price action, market structure. So market structure gives me bias in the sense of, direction based on candles, and then these liquidity zones give me bias in terms of liquidity. Like, where is the liquidity? Where is the order? Or where are the pending orders sitting? Okay, it's an approximation of key levels or key zones above and below price, where you could see a potential um, draw, on liquidity. So another example where this is in hindsight. But I've been paying attention to this chart for quite some time. So this is IWM. So let's go to the futures contract. So if we go to RTY, let's go to the continuous one so we can see more price levels here. Remove drawings. So, you can see if you look at my previous videos, I think I had I made a video about a month ago, and I was looking at this chart, and we were down here somewhere, and my eye just went up to these triple tops, okay, and I knew that eventually those triple tops would have gotten hit, and now we're very close to kind of trading through them, but at the time where we were down here, we had a massive number here that's telling you that there's a lot of interest. There's a lot of orders sitting up there just waiting. Okay. So this level here, in my opinion, is not quite right now. We don't have, so like this high here got breached. Okay. This high got breached, and this high here got breached as well. Okay. So all these orders, prior to these levels being hit, yeah, I wish I had an image to show you what this looked like in the past, but we had a big number here because we had all these triple tops showing up. Okay, so we were down here, and sure, the low risk trade would have been to take a position here, knowing that this level was also pretty massive. Okay, but not as massive as this one. So going long here, or maybe being a little bit more conservative and waiting for it to trade above equilibrium, and then taking a, well, I would say not conservative. It would be a little bit more aggressive because this would have been the better entry because you have a very high reward to risk. If you were to just hold on to your trade and you know, wait for this level to get breached. And I don't think we're, looking at this level right here, I think we have to take into account that, and this is, aside from this indicator, but based on my experience and the studies that I've made, when a level is hit multiple times, you know, two, three, more than three times, on the fourth hit, you rarely see this trade all the way down and go to the other side. This is going to break. I mean, this is going to be a pretty massive breakout, in my opinion. And we're going to probably want to look for, this level, for example, the 2,500 level to be the next level of interest. So if we go to a weekly chart, we can kind of see that level a little bit better, so this is going to be a very interesting zone, and I think that we're near a pretty massive breakout. That's my opinion. I'm going to be really paying attention to this chart in the next couple days. I'll be honest with you, I did not participate on this entire move here. I took a piece. So I want to I want to get back into this trade and look for this level here as a target. This is a longer term trade, by the way. Okay. I generally don't hold trades for weeks or months, but at this point, the volatility is pretty low across all equities. So trending environments are in favor right now, and we may get a pretty massive trend. in the Russell 2000, because even though Nasdaq and ES are close to all-time highs, Russell has been struggling and has been lagging. But um, I think this particular asset here is going to have to do some major catching up. So, anyways, I hope you guys. Well, it's just one of you guys right now, but hey Casey, I don't know if you're still around, but hope this made sense to you. If anybody is interested in trying these indicators out, I do provide a 1 week free trial, and just message me on TradingView, and I'd be happy to share this indicator with you. This one, and also, so this is the QAI structure navigator, and then this one here is the liquidity one. It's called the bias navigator AI. Okay. Um, and this one is they both have some AI capabilities in here. Absolutely not. There's no like learning per se, like machine learning, but there's definitely some pretty complex logic in there that I've um, integrated. So, anyways, I am done for today, and I will talk to you next time.